5 years and specialize in protecting your investments in turbulent times. Call now or visit our website to get our free special report, Global Credit Crisis Act 2, the steps you need to take now to help protect and potentially grow your investments.
Many banks continue to have a large volume of troubled loans on their books, and bank lending standards remain tight. With credit demand weak and with banks writing down problem credits, bank loans outstanding have continued to contract. Small businesses, which depend importantly on bank credit, have been particularly hard hit.
Welcome back to Money and Markets. Another downturn in the U.S. will mean hard times for companies all across sectors of the economy, but it is likely to be particularly tough on banks because, of course, recessions lead to more delinquencies and defaults on everything from mortgages to auto loans to credit card bills. Now, a few weeks ago, we told you which financial institutions are best positioned to weather another crisis and which are in danger of failing. Now, since then, the problems on the bank's balance sheets have only gotten worse. Weiss Ratings measured nearly 8,000 banks and thrifts based on their capital, earnings, loan portfolios, liquidity, and other factors. In the previous review, based on 2009 data, the banks on Weiss Ratings' weakest list controlled a little under 44% of the industry's assets. Now, that's a big percentage, but the latest numbers are even scarier. Now the weakest banks and thrifts, those that received a D+ or lower from Weiss Ratings, hold nearly 53% of the industry's total assets. That is $7 trillion in the hands of struggling financial institutions. Excessive risk-taking and inadequate capital caused the last financial crisis, and of course we can see it taking a toll here all over again. Already this year, more than 100 banks have failed. Now compare that to 64 at this time last year, and there will surely be even more failures to come. According to Martin Weiss, the president and founder of Weiss Ratings, if the economy suffers a double-dip recession, we could see further loan losses from mortgages and high-risk derivatives threatening a return of the debt crisis. And it's not just the regional and small cap names that are in danger of collapse here. Weiss Ratings' list of the weakest banks and thrifts also contains some of the country's biggest financial institutions. Names like Bank of America, Citibank, and Wells Fargo all receive D ratings. U.S. Bank and PNC also fall on the weakest list based on Weiss Ratings criteria. So investors would be wise to stay far away from any of those banks. Unfortunately, financial regulatory reform is not helping matters much here either. Martin Weiss says that some of the new law's provisions are positive first steps toward helping to reduce risk-taking by financial institutions, but in some future boom cycle, they do very little here to avert another round of the current debt crisis. There is some good news out there, though. Despite all the weakness in the financial sector, consumers and investors can still find safe places for their money. More than 900 banks and thrifts earn grades of B+ or better from Weiss Ratings, meaning that they're relatively safe. The largest of these are State Street Bank and Trust, Goldman Sachs, Silicon Valley Bank, GE Capital Financial, and International Bank of Commerce. In fact, GE Capital Financial even earned an A from Weiss Ratings. So if you're looking for smart picks in the financial sector, well, this list is a pretty good place to start. And you can get the full list of the nation's strongest and weakest banks for free by just going to weissratings.com. Martin Weiss will be here in just a few minutes with a special closing commentary. Up next, though, Peter Schiff is back with his policy prescriptions for heading off another recession. What would he do as a U.S. Senator to help turn this economy around? Stay tuned to Money and Markets.
Hi there, this is Mike Larson, editor of Weiss Research's Safe Money Report. You can't just focus on stocks anymore if you want to be a successful investor, and you can't just focus on the United States either. You need to know what's going on in Asia, which Tony covers. You need to know what's going on in hard assets like oil and gold, which Sean and Larry are on top of. You need to know what's happening in currencies, the specialty of Brian Rich. You also need to keep abreast of the best ways to build wealth in an era of near 0% interest rates, and that's what my colleague Nilis Mativ covers. And of course, you need the top-down, big-picture analysis that Safe Money delivers to you each and every month. Best of all, the Weiss Elite membership gives you access to all of that and more. The Weiss Elite gives you the tools and knowledge to profit from all of these market developments. Now, I may be biased, but I think it's a no-brainer, and I'm glad you're one of the smart investors who recognizes that fact. Thanks for your time.
One factor underlying the committee's somewhat weaker outlook is that financial conditions, though much improved since the depth of the financial crisis, have become less supportive of growth in recent months.
Welcome back to Money and Markets. Now, we have heard all about the problems facing the U.S. economy, but it's time now to dig a little bit deeper into the possible solutions. Rejoining us from Fairfield, Connecticut with his policy prescriptions is Senate candidate and president of Euro-Pacific Capital, Peter Schiff. Now, Peter, we talked a little bit earlier about what the Federal Reserve could do to help prop up this economy. What do you think the role of the central bank should be here?
Yeah, well, we don't want to prop up this economy. That's the problem. It's phony. It's a bubble. It exists simply because we're borrowing and spending money. You have inflated asset prices. We have to remove the props. The only way we can rebuild a real economy is to let the phony one collapse. And that's what has to happen. And the sooner we can address these imbalances, the sooner we can begin building a foundation upon which lasting recovery can be based.
Okay, you have been an outspoken opponent of much of what the government's spending. We're hearing that, of course, now both under President Obama and President Bush. Where should taxpayers' money then be directed?
The taxpayers' money should be left with the taxpayers so that they can invest it, so that they can spend it. It's not up to the government. It's not their money. They didn't earn it. I want to make government as small as possible, particularly on the federal level. The federal government needs to stay within the confines of the Constitution. You know, the federal government has very few the powers. They're clearly defined in Article 1, Section 8. That's what they need to do. Everything else, they need to not do it all or leave to the states. And so I want to abolish most of the federal government. You know, and even if I cut the federal government in half, if I halved federal spending, that would just take us back to 2000. The government is spending twice as much today as it did 10 years ago. How can we possibly afford that? The answer is we can't. That's why we're in so much trouble.
Okay, another debate about what we can't afford. Unemployment benefits, where do you stand on extending those?
No, we've extended them too many times already. I want people to get jobs, not unemployment checks. The problem is we've made it very lucrative to collect unemployment. Here in Connecticut, where I live, people can get over $500 a week on unemployment. And if you can do that for a couple of years, you know, why work? I mean, sure, if you can get a really high-paying job, but if you're getting $500 a week on unemployment, no one's going to take a job that only pays $600 or $700 a week, because by the time you finish paying taxes, you're better off on unemployment. Meanwhile, you don't have to commute. You get a lot of time off. You don't have to pay child care. In fact, you can be with your kids. I mean, we're creating a permanent entitlement of unemployment compensation. And I've talked to businesses in the state of Connecticut. They can't hire people. In fact, the only people who are willing to work is if you pay them under the table, because they don't want to lose their unemployment benefits.
All right, tax cuts enacted under President Bush, as you know, they're about to expire. Should they expire, or would you vote to make them permanent?
Well, I want to cut taxes even further, so I don't want them to expire. But I understand that the true cost of government is not what it taxes, but what it spends. And the only way to give us legitimate tax relief is to reduce government spending. Because running these huge deficits, right now we're running budget deficits of about $1.5 trillion per year. That's worse than $1.5 trillion in taxes, because we have to pay for this one way or another. So if we're not paying for it in taxes, we're going to pay for it with inflation when they have to print the money. And if they're not going to inflate, then they're simply going to have to raise taxes that much more in the future to not only pay for all this spending, but all the interest. You know, borrowing and spending is worse for the economy than taxing and spending. Not only do you have to deal with the interest, but when the government taxes us, some of the money that they're taking is money that we would have spent. And so the government spends it instead. I'd rather we spend it. But when they borrow, 100% of the money they borrow is money that would have been invested, that would have been used to grow the economy, to provide goods and services, to create jobs. And when you take that money away, it's like you're taking a seed cord away. You're destroying the economy even worse. So we have to attack the spending even more than the taxes.
Okay, a lot of flap over the recent financial regulatory reform. What do we need here?
We need less regulation. You know, all this financial reform is doing is exacerbating the problems. We didn't have a financial crisis because of a lack of regulation, but because of an excess of it. That's the reason I was able to predict it in advance, because I understood how government policy, both at the Fed, Congress, Fannie and Freddie, FHA, I understood the dynamics and how government was interfering with the market to inflate the bubble. And that's how I knew it would burst. And all the people that say we need government solutions are the same people that said there was no problem a few years ago, that everything was great. So this is just an excuse to expand government, where it's a tax hike. It does nothing to address the real underlying causes of the financial crisis. In fact, they're continuing to do even more damage. The Fed is doing more damage now than before. Fannie and Freddie, FHA, they're doing more damage. They're insuring even more mortgages. We still have the FDIC intact. That's creating more problems. So we've done nothing to solve them. We've made them worse. We're not preventing the next financial crisis. All we've done is ensure that it's a lot worse.
Okay, you're elected to the Senate this fall. What is going to be the first piece of legislation that you would want to propose?
Well, all the legislation that I propose is going to start with the same words: to repeal, to abolish. I don't want to write any new legislation. I just want to repeal the legislation that already exists. Every time I repeal a law, I'm going to restore freedom in this country. And that's what I want to do. I want to undo all the damage that's been done. And the first thing that I want to do is I want to lead the filibuster in the United States Senate against raising the debt ceiling. Every year, our Congress votes to increase the debt ceiling. And those same congressmen go back to their constituents and campaign that they want a balanced budget amendment, that they're fiscally responsible. I'm going to end that hypocrisy once and for all. I'm going to stand up in the United States Senate. I'm going to lead that filibuster. And if 40 senators will stand with me, we will stop deficit spending dead in its tracks. We will force the government to slash spending. And we will end Obamacare once and for all. We don't have to repeal it. If I get elected to the United States Senate, they won't be able to fund it.
Peter Schiff, thanks so much for your time. Good luck to you on the campaign trail.
Thanks a lot.
Okay, that's it for this edition of Money and Markets. Next week, we're spanning the globe looking for investment opportunities. Given the uncertainty in the U.S. market, some of your best bets may indeed be overseas. We'll take an in-depth look at Latin America, Asia, and other emerging economies to help you find the gems hidden in those far-flung markets. And remember, if you have suggestions for topics that you'd like us to cover on Money and Markets or questions for any of this week's guests, just email us at weissmoneynetwork@weissinc.com. I'm Jamie Holmes, and now, Martin Weiss.
Thank you, Jamie. With so much bad economic news hitting so quickly, this is the time to sit back and look at the big picture of the past decade. And when we do, two things become blatantly obvious. First, it's obvious the U.S. is in big trouble. Since the year 2000, we've had two speculative bubbles and two busts. We've had the worst bear markets since the crash of 1929 and the worst recession since the Great Depression. Second, it's equally obvious that the government is fighting this tooth and nail. Just in the past 10 years, we've seen more interest rate cutting, more government spending, bigger bailouts, and larger deficits than in all the 224 years of our nation's history that preceded it. This is war, pitting Washington against the economy. And regardless of the precise outcome, we can say one thing with relative certainty: the war will continue. In this war, never underestimate how quickly the economy can unravel or how deeply your investments can fall. And by the same token, never make the mistake of assuming that Washington has completely run out of rabbits that it can pull out of the hat. Right now, however, it lacks the political will and the financial resources for more massive bailouts and rescues. According to SIGTARP, the government agency overseeing the bailouts, Washington has already spent or printed $3.7 trillion to prevent a Great Depression, and it is not working. This leaves you only one choice. You must prepare for the next phase of this Great Recession by getting your money to safety. Plus, you must also brace yourself for the government's next act of desperation to combat this Great Recession. This is Martin Weiss for Money and Markets. See you next week.